Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are
the Money Café.
Money Café. So, a bit of news around this morning, James. Federal Reserve held as fully expected by the market, and also there were two dissenters.
Yes, Governor Wallace and Governor Bowman dissented. I think you can understand why they're dissenting. There's some GDP numbers out on Wednesday night as well. The headline looked good, 3% economic growth, but the measures of private consumption and business consumption, they are slowing rapidly. The sort of combined measure there was down at 1.2%. In June, for the June quarter, that's down from 1.9% in the March quarter and down from 2.9% at the end of last year. So the US economy is starting to slow under the weight of tariffs and reduced immigration. So the Fed's in a really Jerome Powell is in an absolute bind. I mean, on one side, you've got this. He doesn't want to move because he knows inflation's coming through from the tariffs, and as he said on Wednesday night, it would be not efficient, in his words, to cut rates now, only for inflation to soar and the Fed to be forced to hike rates almost immediately. That doesn't make sense to him. You get the logic. So he's got the tariff part on one side. The other part, he's got, financial markets surging, all-time highs on stocks, gold, crypto, house prices in America. So, as he said, there's no real signs that these restrictive rates are smashing the economy or anything. But the data is showing that the labour market is just starting to crack at the edges and the economy's starting to slow. He's in a horrible position, I reckon, Alan.
Well, yeah, but the GDP, as you point out, GDP bounced back. It was the previous quarter, it was half % contraction, and now it's 3% annual rate. So
that's tariffs too? That's businesses pulling forward activity to try and beat the tariffs. Right. So none of this data, all of this data has become very untrustworthy over the last couple of years. It's become even more untrustworthy since Elon Musk went and Dogeified the US bureaucracy. The data collection's even weaker now. But what we can see is that under the surface, things are starting to slow. So Powell's he's in such a tough spot. He's in a real bind, I reckon. But look, whatever. The markets say whatever because we got some stonking tech results from Meta Platforms, which owns Facebook and Instagram, and we got another stonking result from Microsoft. And, any disappointment that investors might have felt about not getting a rate cut and having a September rate cut sort of disappear into the distance. The moves in these stocks in the after hours markets, Alan, they are incredible. Meta Platforms is up almost 12%. The thing's risen 43% in the last 3 and a bit months, and now it's up another 12%. Microsoft's up another 8.5%. These are huge moves. These are big companies, and these are big moves. So
that's right.
Microsoft,
I noticed Microsoft's profit for the quarter was $27 billion. It's making $100 billion in profit per year, annualized, and the margin on its revenue is 35%.
Yeah, amazing.
It's unbelievable.
Yeah.
No wonder the market's bloody roaring.
Oh, yeah, sure. But these companies put up pretty amazing numbers every quarter, and we sort of become blasé about it. But what is encouraging, if you look at those numbers, is that they're starting to see the AI investments that they're making convert into revenue. So in Microsoft, that comes through in their Azure cloud business. In Meta Platforms, it really comes through in their advertising. So Meta's put the price of its advertising, I think it was up 9% in the last quarter.
Right.
because it's able to, serve up better ads or more relevant ads, more targeted ads through AI. So we're starting to see this investment pay off. We've started to see this week a few job cuts in Australia related to AI. I think it's happening.
And Mark Zuckerberg of Meta also talked about their big project for superintelligence.
Yes.
And how, because they've been hiring and paying like 100 million bonuses to sign-on bonuses to people.
Yeah. Sort of what I got to join the Money Café podcast.
Yeah, that's right. So, but apparently people have been knocking him back. But
do you quite understand what superintelligence is?
Oh yeah, it's just what he's talking about is building AI that is more intelligent than human beings, and that's the kind of the project that they're all on now, to build what's called AGI, artificial general intelligence. And the question is when can they achieve that, and what will happen when it is achieved, where the machines are more intelligent than us?
Yeah,
because that's what they're going for. I mean, and like nobody's sitting back thinking, hey, is this a good idea or not? Because they all think they're going to make tons of money, so they're just going for it.
No. Well, I guess the only people sitting back and thinking that, I mean, we saw the ACTU, the Australian Council of Trade Unions this week, talk about or suggest that there needs to be a compact, I guess, or agreements in place with workers where companies will only introduce AI where it won't affect jobs. Which I think is a little bit, there's a horse that's bolted there. You can understand where they're coming from. You can see.
Yeah, of course.
They can see what's coming.
I moderated a productivity panel, or Flash was called a Flash Forum on Tuesday.
Oh, you were there. Okay, this was.
Well, I moderated it, and one of the presenters. There were sort of 10 presenters, each had 5 minutes.
Right.
And I had to keep them to 5 minutes, which was actually not too hard, to be honest. But anyway, one of them was Joseph Mitchell, the Assistant Secretary of the ACTU, and he talked about one of the things he wants. One of the things the ACTU wants is a rule that says companies can only introduce AI once they've done a deal with the workers. I just don't think that's going to happen.
No. Well, it's too late already.
But there were a few interesting ideas. I thought the best one was from Bruce Chapman, who's Professor of Economics at ANU, and he was the architect of the HEX system for tertiary education. And he talked about lifelong learning and how people need to be better able to go back to university in their 40s when they're, your age or whatever. But the trouble is you can't afford to at the moment because you've got kids and mortgage and you can't possibly give up your job and go back to uni. So he wants to see a HEX system for older, mature age learners that would enable you, if you wanted to go back to uni on the government's money to keep paying your mortgage and everything, and then you'd pay it back in the same way as HEX works.
Yeah.
So I thought that was interesting.
That's an interesting idea, yeah.
Alan Fells wants a new competition prices commission that independently reviews laws and regulations all the time.
Right.
Andrew Barker, the chief economist of CEDA, said we need another institution that kind of unifies laws and regulations across Australia because there's too much difference between the states.
Like that idea. That's come through in a lot of the submissions to the...
So he wants to see national environment rules, national occupational licensing, because every state's got different licenses for various occupations. So it makes it difficult to move between states. A national heavy vehicle regime, uniform payroll tax, and a central agency responsible for reform. I thought that was all right.
Yeah. I think, Alan, I mean, we had Commonwealth Bank's productivity submission a few weeks ago. We've had Westpac, SGH, which is formerly known as Seven Group Holdings, the Stokes family's business. We had McKinsey. I reckon we're starting to get a bit of a plan, something actionable. If you sort of take Matt Common's view that the way to sell productivity is that if we can't get more from less, living standards are going to decrease for our kids and grandkids. I think that's the selling point. That's the bit that makes people prepared to sacrifice something, give up something for this sort of to push this forward. I think McKinsey provided a bit of a North Star. That private investment needs to increase by an additional $130 billion a year. So that means lots of new big projects, lots of new infrastructure. So that's the thing we aim for. And then what we're hearing from a lot of companies is, to your point that you just raised, a lot of this comes back to how do we make planning and approvals simpler, easier to navigate, less duplication, less streamline the rules between state, federal, local governments. I reckon, I don't know, maybe I'm being optimistic, but I reckon there's the start of there's a starting point there.
Yeah, no, I agree. I'm starting to feel optimistic about it. I wasn't to begin with. I thought, oh, God, so I'll just sit around arguing for 3 days and, nothing will happen. But I think that there's a genuine kind of desire for reform in some way. And I think that it won't just be an argument about tax reform.
Yeah.
I mean, if they just sit around talking about tax reform, nothing will get done because they won't agree on anything. And anyway, the government's view of tax reform is higher taxes.
Yes.
Because they absolutely have to have it. They need to. Treasury's told them they've got to increase the tax revenue.
Yeah. But I think that, those sort of four things, that gives us a bit of a framework. There's been some other great. I thought the Westpac CEO Anthony Miller had a great idea around planning out our next set of regional cities. What are the next set of regional cities that are big enough to support jobs and infrastructure and more housing stock? Like that to me is it's a pretty simple idea, but.
Yeah, no. Ken Henry's been saying that we need another city of 5 to 10 million people. Somewhere.
Yeah.
Because that's particularly if we're going to keep increasing the population as we are. There has to be another region. There has to be another city somewhere.
Yeah. So I think it's it's easy to be cynical about this, but I think like the quality of ideas and I think the pragmatism. People not getting too bogged down in the or trying to find bite-sized things that are actually doable. I think it's quite admirable. I really hope, we don't just end up with the usual productivity commission list of things to do that everyone ignores.
Yeah. No, and I hope they really focus on AI too, because I think it's the centre of everything.
Totally. And it's going to matter more than almost everything that we discuss at this.
Yeah, I think so.
Yeah.
What else is on your list?
I just wanted to mention there was a downgrade the other day, profit downgrade from a company called Viva Energy, which is a big petrol station operator. They operate brands like Shell and Ready Express and On the Go. I'm stunned by the number in here about tobacco sales falling. Tobacco sales for Vivas fell 17% in 2024. In the first 6 months of this year, they're down 27%. And as I sort of dug into this, just the sort of perverse way well-meaning regulation is opening up the market for these the organised crime to sell illegal tobacco. So, like, obviously, we've known of this problem, particularly for us in Victoria, for some time. But even in the last little while, Alan, there were changes introduced on July 1 where you can only sell legal tobacco products can only be sold in packs of 20 now. And the idea is that, if you are a pack-a-day smoker, it's better that the pack is smaller, right? And so you can understand that. Fair enough. And they've also outlawed on July 1 menthol cigarettes and a product called Fresh Burst, which is where there's a little ball in the filter of the cigarette. You crush it and you get a sort of minty flavour in addition to the tobacco flavour.
I didn't know that.
Yeah, they were 20% of the market, those products, right?
They've been outlawed.
Outlawed from July 1.
Jeez.
But the problem is, all of these changes, you can understand them. They're well-meaning on a health basis. But the illegal tobacco providers, they don't have to abide by any of these rules. They're not selling packs of 20. They're selling packs of 30 and 50, and they're selling them for $15 a pack rather than $50 a pack. They're not worrying about these rules against menthol cigarettes or these fresh burst cigarettes. In fact, they're bringing in products from overseas that have all sorts of flavors in the filter of the cigarette. And we've outlawed those in Australia for decades. So it's just this amazing shift. Every time there's some change to the way legal tobacco sales are handled, the illegal guys profit from it. And
yeah, but the thing is that they're able to sell them.
That's right.
They're illegal, right. but it's easier to sell them, and so the governments, none of the governments have any idea how to shut them down.
Well, part of the problem here, Alan, is that the federal government collects all the excise. It's up to the state governments to do all the law enforcement, but they're getting no money to do that law enforcement.
Right.
So we've got this. Anyway, it's just to me, it's a little thing that's happening in our society that, you know, spills over into the crime pages, I guess you might say, every now and again. But this is an incredible change in the economics of a $15 billion a year business. You know, the estimates now are that half of tobacco consumption is illegal, is via illicit products. That's just, to me, that's like a stunning shift in the economics of an industry in 5 years. I just thought a really interesting sort of thing that's happening that, you know, we don't realise.
It certainly is incredible that half of a particular industry has become illegal.
Yeah.
It's unbelievable.
Yeah.
And sustainably illegal.
Sustainably illegal, yeah. And probably, you know, such is the level of crime and the falling revenue that legitimate providers are getting out of these products, that we might see it's not impossible to see the supermarkets, for example, leave the industry completely. Just, you know, why bother with this anymore? It's not worth it. And in which case you could see illicit tobacco become, I don't know, pick a number, 70% of the industry. Like, it's just amazing. Anyway.
But it's hard to buy cigarettes at supermarkets, isn't it? I mean, they're all behind the locked box or something.
Absolutely, it's like that at every retailer, every legitimate retailer. But so you know, the combination of crime, of falling sales, falling margins, it may just, and you know, for the supermarkets, it's 2 or 3% of their revenue. They might just go, not worth the hassle, sorry, and leave the industry completely. Which is it's one of those sort of things. Part of you says, well, smoking's bad, you know. Is that the worst thing that could happen if Coles and Woolies stop selling cigarettes? But part of you says, well, the answer to that will be organised crime picking up that part of the market. It's just a fascinating sort of little thing that's occurring in Australian society.
It is. That's right. And just before we move to questions, yesterday's CPI inflation rate came in as expected, more or less as the Reserve Bank had forecast. So way is clear now for a rate cut in a couple of weeks' time. Yeah.
Are you as sure as you were in July, Alan?
Oh, well, you know, the market's 100% odd, 100% certain of it. I suppose I am. Yeah, sure. Yeah. I mean, I don't know what's going to happen in the next 2 weeks that'll stop it. But
I think that's right. That's right. It's going to be interesting how much further they can go. I mean, I bet there's been some fascinating economic stuff around, you know, just making the point that because our productivity is so poor, the rate at which inflation will kick back up, even on pretty tepid economic growth, is something that the RBA is going to need to watch. So, yeah, how many more rate cuts they've got in them after this one is the big question.
Yes, that was your column this morning. But the market's saying the cash rate stops at 3% next year.
Yes.
And that assumes that one of the cuts will be 0.1 rather than 0.25.
Yeah.
Which kind of makes sense.
Yeah.
Maybe the last one they'll do a couple and then a 0.1 to get us back to the round numbers.
Like a special dividend.
Like a special dividend, yeah.
Yeah.
Yeah, very good. Okay, before we move on to questions, let's have a quick word from our sponsor.
Think investing's out of reach? Think again. With InvestSMART's Fund Later, you can own a $10,000 ETF portfolio with just $4,000 up front. Fund Later covers the rest, lending you $6,000, which you repay over 20 monthly installments, including a facility fee. There's no interest, no margin calls, and no waiting. Whether you're new to investing or a parent looking to give your kids a brighter future, it's a smart way to fast-track your investment journey. Choose from 4 expertly managed portfolios and get $10,000 working for you from day one. Learn more at fundlater.com.au. Terms and conditions apply.
Okay, first question is from Ben. As a millennial in the top tax bracket, it is great to see discussion about tax reform and productivity. To me, the two go hand in hand with our current fiscal and tax settings taxing income higher than speculation on housing. The sceptical side of me is worried that any tax reform might not address this, and Australia will continue on its current trajectory of a housing pyramid scheme enabled by selling iron ore and mass immigration. Please shed some wisdom to resuscitate my optimism of meaningful tax reform this election cycle.
I'm not sure about this election cycle, Ben. Yeah, I mean, there might be some tax reform ideas that come out of this productivity summit. Don't know, the changes to the GST, changes to capital gains, some sort of inheritance or wealth taxes. I mean, all of those would need to be taken to the next election, wouldn't they, Alan? So you sort of got two bars to get to jump over. You've got to build the political support in the next couple of years and then try and get it past the election. So I don't know. Does Labor have it in them to tackle something as big as that? Not sure.
I guess Ben's talking about, if he's referring to housing, he's talking about the negative gearing and capital gains tax discount.
Yep.
And that seems to be kind of kryptonite for the Labor Party. So I think you're right. They won't do it before the next election. Those things, at least, and might never do it. What they need to do is raise revenue. I mean, obviously, halving the capital gains tax discount back to 25%, which is what ought to happen, would help with revenue.
Yep.
But I think the main thing they need to do with tax is to introduce a carbon tax, but they probably won't do that either.
No. One thing I will say, I reckon it's been really interesting in the last little while, the leaks that are coming out of different parts of government, Alan. Like last week we had, I think Tanya Plibersek was told by her ministry that there's too many wealthy retirees who are managing to claim a pension or a part pension despite, obvious and large amounts of wealth. I thought that was interesting. We're starting to see these little suggestions being aired that, there's various changes that could be made. Just the fact that those are getting into the public view, I think, is interesting.
It is.
Maybe there's more appetite for reform than we necessarily think.
Well, I do think that we're in the same situation as we were in 85 and 2000 when tax revenue just simply wasn't enough to meet the modern demands on government spending. And so they've got to do something. And, they need to dress up any tax increase with reform. You know what I mean? Like it can't be just we're just going to put up the GST rate to 15%, everybody. There you go.
Yeah.
So they can't and won't do that, but if it's buried inside a big tax reform package, maybe they'll do it.
Yeah, no, fair enough. Well, we got a message. We got a correspondence here from someone called Barbecue Area. I think that's a non-de-plume. He says, lads, I'm an assistant principal in a primary school, and I've noticed an increasing trend of staff requests to work 4 days a week, so 0.8 full-time equivalent, due to the fifth day of work not being worth it due to the amount of tax paid. This is being asked by both men and women. My question is, are these part-time requests contributing to our productivity problem? Also, why are teachers who are not highly paid landing in a high tax bracket? That's a good question.
Yeah, that's right. So one of the factors about Australia is that our top marginal tax rate kicks in I think, among the earliest in the world. So while our tax rate is perhaps not as high as some, 45% plus Medibank levy, Medicare levy, that kicks in pretty early, about 180,000, and I think that's not much money these days.
Yeah. It's interesting. I find this really interesting that people are doing the sums on that and saying, look, the payoff's not good enough. That to me is the interesting part of that. Are the part-time requests contributing to our productivity problem? Oh, probably not. But it is interesting that it's sort of a real life example of how our tax brackets do sting.
David says, after looking at a graph Alan had in the weekend briefing last week showing superannuation share of bank ownership, I thought of the following question: will there come a time in the future when super funds are the majority owners of all the big banks and other large cap Australian companies? And what impact could this have on governance of these businesses, if any?
Yeah, I think this is a really interesting question. I think there could come a time when super funds are the majority of owners of most of the big banks, although I think in general the Australian super sector is starting to get capped out as to the level of money they can put to work in the Australian market. We're probably not quite there, but we're not getting too far off it. Most of the marginal dollars of our super sector are heading into offshore markets because they're sort of full up at home, basically. So, could there be a time when super funds start to influence the governance? They already are. That they're very strident on their views on a range of issues, and you can see that as being as good or bad. I mean, industry funds come from a certain perspective. And some people, there's been accusations from some of the sections of the media that you could end up with sort of a woke influence on boards. The other way to look at it is super fund money is 20, 30, 40-year money, and that could bring a dose of long-termism to companies that is often sadly lacking. So, yeah, it's a tough one, isn't it?
Yeah, look, I think I agree. The super funds are already big influences on all companies, not just the banks. And the question whether or not the super funds vote for something at an annual meeting is the main question at the moment. Even though they're not majority owners, they've got enough to more or less be in charge.
Yeah, remember the super funds have a fiduciary duty. They've got a best interest test. Everything they do has got to be in the best financial interest of members. So that's a pretty clear North Star for them, and from what we see, they stick to it pretty well. Nick says, I'm loving listening to the podcast each week and then discussing it with my brother the following week over breakfast. Less of a question and more of a statement. I'm a little bit dubious of everyone saying we just need to build more homes. Every major asset class across the world in all markets is at or near its peak. Isn't it a bit naive to assume for this one particular asset we have a supply side constraint? Isn't this really about runaway wealth inequality and almost 20 years of post-GFC macroeconomic policy and tax laws that have served to make the rich richer? Keen to hear your thoughts.
And he has a side note.
Oh, sorry, I missed that, Alan. Yes,
you got to not. Well, the thing is that quite a few of our questioners asked this.
You're right.
And Nick says the golf courses should go. My local cafe is all of 250 square metres in footprint and services a greater chunk of the population than the golf course 2,000 times its size.
Oh, yes.
So
we had
there's quite a few people agreeing with my proposition to get rid of the golf courses, or at least some of them.
Yeah.
But anyway, back to the main part of Nick's question. Well, the thing about housing as an asset is that you've got to live in them. So they're a different kind of asset. It's not just an asset class. The whole thing about housing affordability is to some extent about homelessness and people in affordable housing and people needing to have somewhere to live. So, if we haven't got enough of those, we need more of them, clearly. And that's the problem. I mean, there's far too many homeless people in Australia. There's more than 100,000, 120,000 people homeless. Well, the government says, United Nations says that housing is a human right, so they need to have a house. So
Yeah.
we're at least 120,000 houses short, just to put the homeless people up.
Yeah, so it is that difference that housing's as you say, a different sort of asset.
But yeah, I mean the other thing about it is that the government is not apparently able to control demand. So the only thing they can really control is supply in this particular market. I mean, you could say, well, they could control demand by cutting immigration, but they're trying to cut immigration and they can't. I mean, it's just kind of seems to be uncontrollable, and partly because most of the immigrants come as students and then they transfer into permanent residence, and it's really difficult to control the students, and also working visas and family. And they're just kind of. I mean, the current run rate of immigration is more than 400,000, and they've predicted that it's going to come down to 260. Well, they're just not going to achieve that.
Yeah, it's a good point.
So they just have to increase supply. I mean, and also the government wants to increase population and wants population to keep growing because it helps the economy. But they just have to build more houses to house the people. Anyway, my turn. Hamish says, "Hey, Alan, thought you might be interested in this somewhat funny, but something I'm sure you don't want to be associated with. Ad that just got suggested to me on YouTube. The whole Alan Kohler says goodbye to this normal life gave me a chuckle. What is this? I mean, there was an ad. That's right. Look, people are using my image and name all the time.
Yeah,
on social media to scams. Christ, it's a bit
bit of a worry.
Well, it's whack-a-mole. Every time you get Facebook to take it down, another one pops up. So I've given up.
Yeah. Well, you should join. I think Andrew Forrest sued Facebook over this. Maybe you need to join a class action with him.
Yeah, righto. Yeah, good idea. My question, says Hamish, is around the stock price movement of publicly listed funds. Let's look at Ophir, for example. They're listed on the ASX as OPH. Over the past 5 years, their stock price has grown by 6%. However, you look at the website, and they say 13.1% per annum over 5 years, and show a performance chart that is very different to their ASX price chart. How do you benefit from their outperformance if you buy the stock through the ASX? So this is a really interesting question, Hamish, and the answer is that this OPH is their high conviction fund, and with all listed investment funds, managed investment funds like this, they can trade at a discount or a premium to their net assets. So when they announce their performance over any period, whether it's a year or 5 years, what they're talking about is the change in their net assets. But the share price does a different thing according to demand for it. And so what's happened with OPH, for example, is that it's gone from a premium over their net assets to a discount. And so the share price has not gone up at the same rate as the performance of their net assets. And this happens quite often. I mean, it can be the case that the share price just tracks the net assets, but not most of the time.
Yeah, and particularly at the moment, listed investment companies almost universally trading at a discount to their net tangible assets, and closing that discount is very much on the mind of the listed investment company operators. I can tell you, it's
yeah. And I think part of the reason for that's happened is that everyone's moving into ETFs, and ETFs always track their net assets because they issue shares accordingly. They don't have a surplus of shares on the market according to demand or a shortage of them.
Yeah. But Hamish raises a good point, doesn't he, Alan? Because you're sort of betting on two things. One, that Ophir can, and other listed investment company operators can beat the market through their fund. But then you're betting that will be recognised by the market such that the shares, trade to reflect that outperformance. It's a good point. You do have to. You're betting on two things.
You can actually invest in the fund itself.
You can, yeah.
But the difference with that is you don't have the same liquidity. If you buy OPH shares, you get to sell them straight away if you want to. But when you're in the fund, everyone's got different kind of selling rules as to how easy it is to get out of them.
Yeah.
So you sort of, in a sense, you're trading off liquidity versus performance.
Yeah, absolutely. Well, we've got an email from Jack, who describes herself as youngish female listener and hopefully future director, which I love. She was disappointed in Money Cafe's resident diversity champion, Stephen, taking a dig at Macquarie board members' ages last week. If the Macquarie directors have failed at governance and oversight, then call that out. But blaming their age is the same as saying Macquarie has had issues because Shamara is female. I'd love to be a successful and contributing member of the society at the age of these directors. I do wonder if the reason we have so many older leaders and directors is related to younger generations tapping out of leadership. And she's referred to a story that was in the AFR about Gen Z doing something called unbossing, which is when they sort of don't want to take on leadership positions. Do you think it is correlation or causation that Gen Z is likely to go for less leadership roles and boomers are still working into years of retirement?
Interesting. Yeah. So
hard to say, isn't it? It's
being a gentleman of a certain age myself, I think that's true. Like, it isn't to do with age. Just because you're in your 70s doesn't mean you're any less good, I'd say. But I think it's also interesting that Gen Z's getting out of leadership, and who can blame them?
Yeah. I think I'm not sure, Jack, what the answer is. I don't think Gen Z. I don't know. Yeah.
Maybe part of the problem is the top marginal tax rate.
Maybe.
The extra grief you get as a leader isn't worth the take-home money.
I'm also wary, Alan, of doing the same thing to Gen Z, which Jack has accused Stephen of doing to older directors. Different people in a generational band like that have different approaches to things. I don't think you can, I'm just wary of this idea of everyone in Gen Z is backing away from leadership. I don't know. I think that these things tend to sort themselves out over time. Let's just wait and see. Maybe Gen Z's not that excited about leadership coming out of the pandemic, but I think the labour market's changing again. I think we can really see, that there was a brief moment there where Labor had the upper hand over capital. I think that's diminishing. AI, the slowing economy. I think we should just be careful of saying that any big workforce trends are locked in.
Yeah, and it's probably true that the market will work. I mean, if the supply of leaders, managers, and so on declines, because Gen Z don't want to go in it, then the price will go up.
People will step up. That's it.
They'll have to pay more and persuade Gen Zers to do it.
Indeed. And I reckon it's great that Jack wants to be a female director down the track too. Good on you. That's exactly. The directors have a fascinating job, and we give them heaps of shtick, but they do play an important role. We want people to do those jobs.
We do, and you just got to do the AICD director's course, and then start off in a not-for-profit, and off you go.
Yeah.
Anyway, Ben says, thanks for your always entertaining podcast. The rate of company tax in Australia and whether it's set appropriately often comes up in this podcast and elsewhere. If it's the case that most business expenditure is tax deductible, then the tax would only be paid on money that's left in the kitty. So is this tax rate a big deal? Am I missing something?
Business tax is taxed on profits, so it's revenue minus expenses. So I guess in that sense,
all business expenditure
is tax deductible.
Yes.
But it's the source of the taxation. We're not taxing on revenue; we're taxing on profit. So that's why the rate of business tax is important.
Yeah, and the other thing is that the business tax is paid by us, consumers, in the end. I mean, the tax just goes on the price.
True.
It's part of the price. So it's another way of taxing us.
Yeah.
I think it's worth pointing out. Mostly, I mean, to some extent, I guess it reduces dividends and so on to shareholders, but it's mostly a tax on us.
Yeah. So yes, Ben, it is important, but it's interesting how little it's being raised in this tax debate. And I have had some correspondents say to me, the one thing about this productivity debate is we are very focused on what's happening in Australia. It's a very domestically focused debate. We're not thinking about the competition from overseas, and that could be a bit of a problem, which I sort of get. It's not just about what the tax rate for company tax is in Australia, and are we happy with that? It's what it is compared to Australia, New Zealand, America, England, 1,000 other countries, because capital can move around. If you're going to set up a project, you can choose to go to one of those other jurisdictions. So anyway, it's interesting. Last lovely one from Maureen. She was so pleased to hear that your response on June 10th, Alan, to yet another person questioning how he can avoid the extra 15% on some of his measly $3 million superannuation. I really enjoy listening to the Money Café, despite, at 83 years old, having neither superannuation nor investments, but happily enjoying recent retirement on the age pension in my own fully paid home. It always astonishes me when I hear of people in their 80s reluctant to downsize their home in case they have too much money to continue receiving the pension. I'm sure there are many such folk. In the mid-1980s, Maureen worked at Scottish Amicable for Don Brinkworth when he was the investment manager. Don had you on a very high pedestal even then, Alan. I know he would be very proud to have known you and witnessed the heights to which you have risen. I think you would remember his reputation as the counter-cyclical investor. And even as someone who left school at 15, Maureen could never understand why he was such an anomaly. It's always just common sense to Maureen. Following these interesting times, I was self-employed until the end of last month, but listening to your program always brings back that time. Thank goodness for your down-to-earth view of the world. Isn't that lovely, Alan?
That was great. And I do remember Don Brinkworth in the 80s, and because in those days it was interesting. There were a group of investment managers in some of these life insurance companies, because wasn't in those days they weren't super funds, they were life insurance companies. And Scottish Amicable was one of them. There was AMP and National Mutual, and they were the kind of they were the elephants in the market in those days. And so I used to talk to them when I was running Chanticleer. In those days, I talked to these people all the time, and they were very interesting because they were kind of pioneers in a way. They were starting to throw their weight around in a way that became the norm for for big fund managers.
Yeah, they were activists before we knew what an activist was, really.
That's right. And the people running the big companies were a bit horrified by it. They were shocked because these guys. Yeah. And the other thing is these fellas people like Don Brinkworth, is that they decided whether the Buccaneers, the big M&A merchants, the takeover crusaders like Alan Bond and John Spelvins and John Elliott and Christopher Skase actually got anywhere. They were the ones who sold them and enabled them in a way in those days. Yeah,
well, it's a fascinating, and how good that Maureen was working until a month ago at 83. That's a great story in itself, I reckon. So thanks, Maureen. You've really made our day. Well, you've made my day anyway.
And mine too. It's great. Thanks for that.
Lovely message.
And that's it for Money Cafe this week. Thanks, everyone, for listening. We'll be back next week. I'll be back next week with Stephen Main. Send in a question to themoneycafe@eurekareport.com.au. Until then, I'm Alan Kohler, founder of Eureka Report, finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
Bye-bye.